What are three stocks which are undervalued right now after they've had a major crash or pullback? Well, in this video, you guys are going to find out. I'm Ben and welcome to Motivation to Invest. We're going to dive into three stocks which have had major crashes and are undervalued right now. I'm going to dive into the business model, the finances, and reveal my buy point for these three stocks. So before we hop right in, guys, if you're new around here and you do like these investing tips and stock market picks, feel free to join the investing family by hitting that subscribe button and turning that notification bell on. And if you find value in this video at any point, feel free to give it a big thumbs up. It helps out tremendously with the channel. With that being said, let's dive in. Hopping in right here, guys, the first stock we're going to dive into is a stock called Boohoo. I've covered this stock many times on this channel. The fast fashion retailer based in the UK, very similar to ASOS. And this stock is an absolute roller coaster for any of you guys that have been invested into it. So if I go back to, let's say, 2017, 2016, the stock has been on a steady incline, which is great, up 160%. February 2020 came, of course, we had the March crash. It crashed down heavy before rebounding. I was trading that stock during those times and I put all my alerts in the VIP group. We had some great gains then. Then it crashed again due to, I believe, a factory scandal. Then it went up again, then it crashed again due to an accounting scandal, and it was just by many, many more scandals. So what's the latest scandal to hit Boohoo stock and increase the volatility of this small cap player? Well, this time it's actually not even that bad, but still the stock dropped by over 15% in a single day. So as you can see here, the stock is down 17%, currently trading at £2.14 per share, as it's a UK company based on the FTSE AIM 100 stock exchange. Now, the reason this fast fashion retailer is down is for a couple of reasons. So Boohoo has recently announced that their margins are going to be squeezed because basically autumn winter clothing is typically sourced from outside of Europe, and Boohoo is having some supply chain issues which are going to increase the costs of their supply chain, lower their margins, and also there's wage inflation which people are talking about, so they're going to have to increase wages for many of their employees. But the way I look at this is a lot of these are extrinsic factors which are going to affect all the players in the fast fashion industry and many different types of businesses, such as import costs, supply chain issues, etc. So for this stock to be hit so hard off that news, I think that is really an overreaction by the stock market again. So to go into a little bit more detail here, the full year underlying EBITDA margins are expected to be 9% to 9.5%, and this is down from the guidance of 9.5% to 10%, so basically 0.5% down with their guidance. Now their sales growth is also expected to be lower, 20 to 25%. Now this is lower than their medium-term sales target of 25%, and previously the company's grown their sales at around 30 to 40%. But even 20%, that is still really good. And this company benefited hugely from the whole lockdown, the whole pandemic, when people were stuck at home and having to shop online. And now the market has just forgot about that. They forgot about the whole situation and they've just said, okay, the company's revised its growth estimates. We're going to absolutely hammer the stock. And that just seems like what is happening right now. But personally, I see this as a buying opportunity. I've actually dived into my valuation model, my advanced valuation model, and I've revised my estimates for this company. Now, so I've dropped the revenue growth to 20%, compound annual growth 20% again. I've dropped their margins from around 7%, which I had, and these are pre-tax operating margins, to around 6% in the next year. So I've actually decreased their margins, decreased their revenue growth to give me a new valuation for this stock, and I get around £2.20 per share, and that is above where it's trading right now. So it's basically undervalued right now, slightly undervalued. Yes, the stock is worth a little bit less at these new estimates, but to me, it's trading at least slightly undervalued right now, if not massively undervalued. Now, is this stock for everybody? No, it's definitely not for everybody. It's an extremely volatile company. But the way I look at this is I think people are overcomplicating this company. It's an e-commerce player which sells clothes to people. That's it, really. And they've got a great market. They've got an established market in the UK. They've got an established brand among young people. They've got great influencer marketing. So they're the real advantages I see with this stock. But it is an extremely volatile stock, and it is a long-term play. Or if you're going to trade these dips and troughs in these increases, then that's also another strategy. Right, on to stock number 2, and this is Take-Two Interactive, completely different type of company. NASDAQ TTWO. This is an established player. They own Rockstar brands. They own 2K, many established gaming brands. They've got Grand Theft Auto franchise. They've got Mafia. They've got Red Dead Redemption and many more. So $213 per share in February 2021. And now the stock actually corrected down by 30%, massively down. It started to recover slightly now by around 6%. And really this decline was for a few factors. So firstly, there was a major decline in all growth stocks across the whole market in February 2021 as interest rates risen. But also the fact that there were a few game delays, and that's what's caused this stock to plummet. Now, of course, gaming delays means less games on the shelves, means less revenue for this company. The market cap $17.95 billion. But personally, again, the Rockstar brand isn't going anywhere. Grand Theft Auto franchise doesn't seem to be going anywhere right now. And there's one major secret with this stock, which I need to tell you guys about on this channel. So apparently an insider who works at Nvidia and does PC game testing for the company was reviewing the testing for certain games, and he stumbled across something incredible. So he stumbled across some unreleased games by Take-Two, and among them was what's called the Grand Theft Auto Trilogy Remastered. So this would be Grand Theft Auto Vice City remastered for the new consoles, Grand Theft Auto San Andreas and Liberty Cities. These would be remastered for the new consoles, and this could be a real game changer. This trilogy could send this stock to the moon. Now, this information isn't 100% verified right now. I did put it in our VIP Discord group, which I'll link to, second link in the description below if you want to be part of it there. These are the type of updates you get in real time. And as you can see, I posted here, this is a screenshot from the employee who works for Nvidia. And he's basically got here Rockstar Games, San Andreas Remastered, Vice City Remastered. And this is from a screenshot which he did when working for the company, apparently. Now remember guys, this is not financial advice, and I'm not telling you guys to do any insider trading. This is basically somebody who works at a different company, not Take-Two, he works at Nvidia, and he's found out some information which he thinks could be useful for the stock, apparently, but I don't consider this insider trading. So nobody sue me, that's my legal disclaimer. Now, if you do want to look into this company from different aspects, you can also see that the gaming market is booming. There will be 177 million monthly gamers in the US this year, meaning more than half of the US population will identify as a digital gamer by the end of 2021. And of course, the trend in gaming was accelerated by the global pandemic and lockdowns, with people stuck at home, and what could they do but play on their computers? So what's the valuation for Take-Two? Well, diving into my advanced valuation model, I've plugged in all the numbers here. I've given these guys a conservative estimate of 10% for the revenue growth, and I get a valuation for the company of $166 per share. Stock's currently trading 153, slightly undervalued right now, about 8%. I did check out another valuation model, and that says the stock is 30% down right now. But there is one red flag I did spot. Now, if we dive in here, the recent insider transactions, we can see there's been a lot of insider selling. So Daniel Emerson, 710K worth of shares at 177. Zenlik Media Corporation, $49 million worth of shares, which is a hell of a lot at $184 per share. Also $7 million worth of shares at $198 per share. So there's been a lot of insider selling, all above the current levels of where the stock is right now, but still seeing those insiders selling is not a good thing from my eyes. But still, if we look at the pure valuation of this company, it does seem to be undervalued right now. So it's up to you guys. You can make your own decision on this one. And finally, stock number 3 on my list is a stock I've covered previously, and that is Zillow, ticker symbol ZG or Z. Now, this stock, again, February 2021, it was at $200 per share, and it's actually down 56%. Crazy decline. Market cap $23 billion. Could this be a buying opportunity? Zillow, for those of you guys that don't know, is the market leading online marketplace for property in the US. So you can buy, sell, and rent property on the platform. So what's the valuation for this company? Well, I've given this company a 45% growth rate, 30% for the next 2 to 5 years. I get a valuation at the moment of $83 per share. The price at the moment, is it $100 still? It's $88 right now. So it's slightly, very slightly above the fair value right now, but it's trading pretty much close to that fair value right now, $88 per share compared to $83 per share. So again, could be a potential buying opportunity. But like I mentioned, guys, this is not financial advice. This is today's video. There's 3 stocks which have had big declines and are looking to be undervalued right now. Of course, they all come with risks. They all come with the risk that they won't recover, but generally it's best to buy stocks when they're down rather than when they are up. It's as simple as that in the stock market. If you guys did find value in this video, feel free to give it a big thumbs up. Helps out tremendously with the channel. If you haven't joined the investing family yet and you do want to get these investing tips and stock picks, feel free by hitting that subscribe button, turning that notification bell on. If you do want to join the VIP group, check out that second link in the description below to get access to my live buys, sells, my entire 6-figure portfolio, and much, much more. If you do want to learn how to become a successful investor using fundamental investment analysis, check out the first link in the description below for our ultimate investing strategy course. With that being said, thank you guys so much for watching. I hope you all have an incredible day. I wish you luck in the markets and invest safe.